You know, the headlines about the market, they might be telling you one thing, but the data, well, that's telling a very different story. Today, we're going to pull back the curtain and uncover that hidden narrative. So, if you just glance at things, it all looks pretty good, right? But when you start to dig a little deeper, there are some really strange signals that just don't add up. The central mystery we're investigating today is what is really going on? What is the market's true identity right now?
Okay, so to figure this out, we first need to understand the two completely conflicting stories the market is telling us at the same time. On one side, you've got this picture of calm. On the other, there's all this hidden stress. It really is a classic tale of two markets.
Let's break these two views down. The calm view is what most people are seeing. Equities are up over 25% in the last year. Amazing. And credit spreads, a key measure of risk, are super tight. This all points to a healthy, risk-on environment. But then you have the stressed view, where you see these really unusual behaviors and broken relationships between assets that suggest something is seriously out of whack.
And this brings us to our first major clue, this number. This represents the percentile of systemic strain across the entire market. Being in the 95th percentile means the financial system is experiencing a level of stress that's higher than 95% of its recent history. For a market that looks so calm on the outside, that is an extremely, extremely high number. So the big question is, where is this stress actually coming from? To answer that, we've got to follow the data and look at the hidden red flags that are causing this high-stress reading. Let's do some detective work.
Okay, our first piece of evidence points to a single, massive outlier. There's one asset that's behaving so differently from everything else that it's actually distorting the entire picture. Think of it like a rogue wave in an otherwise calm sea.
And this chart right here shows you exactly what's happening. I mean, look at this. Equities delivered a fantastic return. Fixed income did okay. But gold's performance, it is on another planet. This isn't just a strong return. It's a statistically extreme move that points to a powerful defensive undercurrent flowing just beneath the surface.
Our next clue is a bit more subtle, but it's potentially even more important. It has to do with a fundamental relationship between the two biggest asset classes out there, stocks and bonds, that is completely broken down. So for the past year, stocks and bonds had a negative correlation. That's what you want to see. It's normal. It means when stocks zig, bonds zag. They provide a safety net for each other. But in the last month, that relationship has completely flipped on its head. The correlation is now almost perfectly positive. That's a massive shift, and it means stocks and bonds are now moving in lockstep.
And here's the crucial point. When that stock-bond correlation turns positive, the traditional 60-40 portfolio loses its main defense mechanism. Bonds just don't act as a hedge anymore. So if some shock hits the market and stocks fall, your bonds are probably going to fall right alongside them. That safety net is just gone.
So these two clues, that massive outlier in gold and the crazy correlation flip, are the major contributors to that high systemic strain reading we talked about. So how is that strain actually measured? Let's take a look under the hood.
The tool that's used to calculate this is kind of like a full-body MRI for the market. It's called Mahalanobis distance. A bit of a mouthful, but basically, instead of just checking one vital sign, it analyzes how everything is working together, and it looks for any unusual patterns. You can just think of it as a really sophisticated statistical alarm bell.
And that is the absolute key takeaway here. The systemic strain rating is high, not because volatility is high or because credit spreads are wide, because they aren't. It's high because the combination of what's happening is so strange. It's the pattern of screaming gold prices plus the synchronized movement of stocks and bonds that is statistically so rare.
And to put this all into context, this slide shows that the current high reading is definitely not normal. It's actually comparable to other well-known periods of major market stress, like that aggressive monetary tightening cycle we saw back in 2022. This tells us that the market's internal mechanics are under some serious pressure.
Okay, so now that we've gathered all our clues, let's put them all together and try to reveal the market's real identity. What's the final diagnosis here?
It looks like the market has a split personality right now. As you can see, the vast majority of assets, 24 of them, are in a low volatility regime. Everything seems fine and dandy, but a critical few, including gold, have completely flipped into a high volatility regime. And that's the source of all the tension, this calm surface with these hidden pockets of extreme turbulence underneath.
This brings us right to the core of the issue. The system is statistically stretched. All the warning lights are flashing on the dashboard, and yet the market isn't pricing a crisis.
The prices of major assets just don't seem to reflect this underlying stress. There is a deep, deep disconnect between the statistical reality and the market's perception.
So we're left with this powerful and, frankly, unsettling question. The data shows a system under a level of strain we really only see during major stress events. The surface, however, remains calm. This state of, let's call it cognitive dissonance, it just can't last forever. So the big question isn't if something will give, but for how long can this fragile balance possibly hold?